Do you hear that silence? That moment where nothing seems to be happening? That's not boredom. That's a market holding its breath. Right now, silver is sitting at $65.77. It's not collapsing, it's not exploding, it's hovering, quiet, tense, refusing to move the way most people expect. To the average viewer, this looks dull. They glance at the chart and think the excitement is over. But to anyone who understands how real breakouts work, this moment is electric. Because silence in a market like this is never empty. It's pressure. It's stored energy. It's the pause right before a decision that can't be undone. And the reason this moment matters so much is because we are not just approaching the end of another trading day. We are approaching the most important moment of the entire week, the weekly close. In institutional finance, daily price action is noise. Weekly closes are verdicts. They decide which side controlled the battlefield, and they feed directly into the models, the risk systems, and the automated strategies that move billions of dollars. For years, silver has tried to break higher, and every time it did, the same script played out. Late Friday pressure, sudden paper selling, a forced pullback designed to make the weekly candle look weak and scare momentum money away. The goal was never just to push price down, it was to damage the chart. This week, the banks tried again. Margin pressure, heavy selling, attempts to shove silver back towards $60. And yet, here we are, still standing near the highs, $65.77. The market absorbed everything. That refusal is the signal. When a market has every reason to fall and it doesn't, that tells you something fundamental has changed. Sellers are trying, but buyers are stronger. Supply is being absorbed without price damage. That's not speculation, that's demand. And that's why this moment feels so tense. Because a strong weekly close doesn't just look bullish, it flips switches. Resistance was $65. If silver holds above that level into the close, the weekly candle confirms a breakout, and confirmation is what activates systematic buying. Trend-following funds don't care about opinions or narratives. They care about rules. And one of those rules is simple. When price closes above a major resistance level on a weekly time frame, capital gets deployed. That's why Friday matters. That's why this level matters. And that's why the silence is so loud. The banks know what a strong weekly close means. They know what happens when models rebalance over the weekend and buying programs turn on. This isn't about a few cents. It's about whether the market prints a message that says the ceiling broke. And when a ceiling breaks and price refuses to fall back below it, the old playbook stops working. Look at what silver did after its run from $60 to $66. In a weak market, that move would have been punished. Price would have collapsed back into the prior range. But silver didn't crash. It paused. It tightened. It consolidated near the highs. That's not weakness. That's strength. It's a classic bull flag, one of the healthiest continuation patterns in technical analysis. People take profits, yes, but new buyers step in immediately. Selling pressure gets absorbed. Price doesn't lose altitude. That tells you demand is waiting underneath the market, ready to buy dips faster than sellers can push them. Think of it like trying to hold a beach ball underwater. You can do it for a while, but it takes effort. Pressure builds, and the moment control slips, the release is violent. That's what tight consolidation near highs represents, stored energy. The banks can stall the move, but if physical demand remains tight, they can't break it. Every attempt to push price lower becomes a discount for buyers who actually need the metal. Over time, that dynamic pours a floor under the market, and right now, that floor is forming around $65. There's also a psychological shift happening that's bigger than most people realize. For years, $65 was treated like a fantasy level, the point where everyone was supposedly going to sell. But we reached it, and the mass selling didn't happen. Some profit-taking, yes, but no collapse, no panic. That matters because when a market reaches a level that was supposed to trigger selling and instead holds, psychology flips. Resistance turns into acceptance. High prices stop killing demand and start attracting it. That's how supercycles begin. Not with euphoria, but with disbelief followed by stubborn strength. Now layer in the derivatives market. Weekly closes don't just affect charts, they affect positioning. Options settle, hedges shift, calls move into the money. Dealers adjust exposure. When price pushes through key levels and stays there, forced buying can emerge, not because anyone wants to buy, but because they have to. And when that happens in a market with tight physical supply, pressure builds quickly. Paper promises stretch, inventories thin. The only way to balance the system is through higher prices. Modern markets are also dominated by algorithms, trend-following systems, volatility models, systematic funds. These programs don't think, they execute. They watch price behavior and closes, not headlines. And when a weekly breakout is confirmed, many of these systems shift posture. They allocate, they size positions. And when markets reopen, they buy. This is why Mondays after major weekly closes can feel explosive. It's not emotion, it's flow. That brings us to the weekend. Most traders fear weekends because markets are closed. But in a tightening global environment, the risk flips. The danger isn't holding the asset, the danger is holding cash. News doesn't stop just because exchanges are closed. Supply disruptions, geopolitical developments, policy shifts, they don't wait for Monday. And when markets reopen after a strong close, price doesn't always reopen where it left off. Sometimes it gaps higher because the market has to reprice to find sellers. That's why strong Friday closes matter so much. They reflect a preference to hold real assets through uncertainty rather than sit in currency while the world keeps moving. Silver sits at the crossroads of finance and industry. It's monetary, but it's also consumed. And in a world that's becoming more fragmented, where nations compete over supply chains and critical materials, that dual role matters. Which leads to an important geopolitical question. In an era of rising strategic competition, can critical commodities become tools of leverage? The answer is yes, and we've already seen it across energy and materials markets. When resources become strategic, supply becomes political. That increases the risk of sudden shortages and accelerates the desire to secure inventory in advance. Markets don't wait for confirmation, they reprice ahead of it. Technically, the roadmap is clear. If $65 holds as support, the next major psychological zone is $70. Round numbers attract attention. Sellers cluster there. But in strong trends, round numbers often act as fuel, not ceilings. Price tests the level, supply comes out, demand absorbs it, and once sellers run out, price moves through faster than expected. Above that, there's less historical resistance and more room for acceleration. Bigger bases tend to produce bigger moves, not because of hype, but because of time and accumulated pressure. None of this means the path will be smooth. Volatility is part of the process. Pullbacks happen, retests happen. The real skill isn't predicting every move, it's recognizing when the trend is intact and refusing to let noise shake you out. The most dangerous moments aren't the drops. They're the quiet weekends filled with commentary designed to plant doubt. That's how positions get stolen, not through force, but through hesitation. There's an old truth in markets. The hardest job is doing nothing, sitting with a winning position, letting the trend work, not overreacting to every headline. If the structure hasn't broken and the thesis hasn't changed, constant action usually does more harm than good. So here's the verdict. This week wasn't about hope. Hope is fragile. Hope panics. What replaced it was evidence. The banks tried to break the market and failed. Price held, structure improved, psychology shifted. The weekly close tells the story. If this level holds, the next phase begins. The machines will read it, capital will respond, and the next battleground comes into view. As the week ends, silver stands at $65.77. Not screaming, not collapsing, just refusing to fall. That's not boring. That's powerful. That's the sound of pressure building. And the question for the coming days isn't whether something happened this week. It's what happens next when the world realizes the floor is real. If global competition continues to intensify and trust in systems continues to erode, hard assets don't need permission to reprice. They do it by necessity. If you want to stay with this story as it unfolds, if you want clear, grounded analysis that cuts through noise and focuses on what the market is actually telling us, subscribe now and stay close. Because the silence you're hearing right now isn't the end of the move. It's the moment right before the next chapter begins.